Hello everyone, I am Dr.A.G.Mythili, Assistant Professor, Department of Commerce with Finance, Dr.A.G.Mythili College of Arts and Science. In this video, I am going to speak about investment in mutual funds. So what is mutual fund? Mutual fund are an investment option that offers easy access, liquidity, straightforward exist and remove investment management risk from the individual investors as professional fund managers manage them. A mutual fund is an investment vehicle that pools funds from investors and invest in equities, bonds, government securities, gold and other assets. Companies that qualify to set up mutual funds create asset management companies or fund houses which pool in the money from investors, market mutual funds, manage investment and enable investors' transactions. So mutual funds are managed by sound financial professionals known as fund managers who have expertise in analyzing and managing investment. The funds collected from investors in mutual funds are invested by fund managers in different financial assets such as stock, bonds and other assets. So coming to the types of mutual fund, based on the structure, there are two types, open-end funds and closed-end funds. So open-end funds are mutual funds that allow you to invest and redeem investment at any time. We can get back our amount at any time. So there is liquidity. Closed-ended schemes have fixed maturity date. Only you can invest at the time of the new fund offers and redemption can only be done on maturity. You can't purchase the unit of a closed-ended mutual fund whenever you want. So based on asset classes, equity mutual funds, debt mutual funds, hybrid mutual funds. So what is equity mutual funds? It is invest at least 65% in their assets in the stocks of the companies listed on the stock exchange. They are more suitable as long-term investment, that is greater than 5 years, as stocks can be volatile in the short term. So debt mutual funds primarily invest in fixed income instruments like government securities, corporate bonds and other debt instruments. They are not affected by stock market volatility and hence can offer more stable returns compared to equity mutual funds. Hybrid mutual funds investment in both equity and debt in varying proportions depending on the investment objective of the fund. Thus, hybrid funds gives you diversified exposure to various asset classes. Coming to the ways or modes of mutual fund investment. An investor can invest in mutual funds in the following ways. He can invest in lump sum or SIP, that is systematic investment plan. So lump sum, when you want to invest a significant amount in a mutual fund in one go, for example, if you have 1 lakh rupees, you can invest in that 1 lakh, entire 1 lakh in the mutual funds at a time. SIP, you also have to option small investment amount in the mutual funds. Say systematic investment plan. It encourages regular investment of fixed amounts bi-monthly, monthly, quarterly and so on. So depending upon your needs and proportion available with the mutual funds, this method of investing includes a discipline. So many investors try to invest in this. So the minimum amount of lump sum in systematic investment plan is 100. So how to invest in mutual funds? So there are broadly 3 ways to invest in any mutual fund scheme: through a mutual fund company's website, through a mutual fund distributor and through an ET money. So features and benefits of mutual funds. So the following are the advantages of investing in mutual funds. Diversification. So the saying, do not put all your eggs in one basket, perfectly fits mutual funds, as spreading investment across multiple securities and assets categories lowers risk. For example, compared to direct equity investment, where your funds are deployed in individual company stock, equity mutual funds investment in a basket of stocks across sectors, thereby reducing risk. Professional management. Mutual funds are managed by full-time professional fund managers who have expertise, experience and resource to actively buy, sell and manage investment. Transparency. Each mutual funds scheme has a information document readily available on the fund house's website that can give you all detailed information, its holdings, fund managers. In addition, the portfolio investment value (NAV) is published daily on the AMC site and AMFI site for investors to track the portfolio of mutual funds. Liquidity. You can redeem your investment or any business working day at NAV of the day of your redemption. Next, tax savings. Investment up to a lakh, 1,50,000 in ELSS mutual fund qualifies a tax benefit under Section 80C of Income Tax Act 1961. Mutual fund investment, whether holds for a longer period or tax efficient choice. There are many options to invest in mutual funds. Meet your different needs. To name a few, liquid funds are of investors looking to benefit from safety or debt and low interest rate risk. Flexi cap funds if you are looking for stock diversification, and solution oriented mutual funds when you are looking for invest for a particular goal like retirement or children education. Cost effective. Mutual funds are a low cost investment vehicle. Pooled investments from several investors in a mutual fund enable the funds to invest in a basket stocks and stock securities which otherwise may not be out of the reach ordinary investors, requires a higher investment of amount. So returns. Mutual fund returns are not assured by mutual funds and are subject to market risk. But over the long term, equity mutual funds have a potential to deliver double-digit returns annually. Debt funds can also offer higher returns as compared to bank deposit. Well regulated. In India, mutual fund industries are regulated by Capital Market Regulatory Securities Exchange Board of India, that is SEBI. Therefore, mutual funds follow stringent rules and regulations ensuring investors' protection, risk mitigation, liquidity, and fair valuation. So there are some disadvantages of mutual funds, that is exit load. Mutual funds generally levy on exit load fee, that is redeeming investments within a specified period, for example 1 year from the date of investment. This is done to refrain investors from existing scheme to early impact. So high cost. SEBI has defined a maximum limit of expense ratio that mutual fund houses can charge, and they depend on the mutual fund size. If the size grows, the expenses tends to come down. The maximum expense ratio that is chargeable for equity oriented mutual funds is 2.25%, and you have to bear this charge irrespective of the performance of the fund when compared to another mode of investment. Over diversification. In the quest of diversifying your investments, you may invest in mutual funds which invest in a vast number of stocks, leading to over diversification. Not all the stocks of the portfolio will deliver high returns all the time. You may incur loss also. Risk. Investment in mutual funds are subject to market risk. The risk of loss faced by all types of securities in the financial markets cannot be reduced by diversification. Market risk may occur due to many macro and microeconomic factors. For example, equity mutual funds are subject to volatility risk owing to fluctuations in the stock market, whereas debt mutual funds are subject to interest rate risk, which is caused by fluctuations in interest rate and so on. Thank you.